finals on finals nights, and students would leave the class all mad, upset, in tears, and totally drenched from sweating. And I decided at some point I didn't want to do that anymore. I thought that was kind of ridiculous. So I got rid of this a while back. Can you do me a favor and go on your computer and tell me what the stock market did today, the Dow Jones Industrial Average? Was it up or down, and if so, why?
Down.
Down by how much?
$53.
Why? What's it done for the whole week, or the whole last week? What?
Has it been because of like relations with China?
Yeah, the trade war, definitely. And I think over the last week it was down how much? If you invest in stock, are you a happy person?
No.
If you have a lot of your money in the stock market and you plan on retiring this year, are you happy?
No.
No. Do you care if the stock market goes up and down? Yeah, probably. Are you going to be invested in stocks?
Yeah.
Probably. So you need to care. Stocks are a leading indicator. So if stocks went down, give me 2 reasons why stocks would go down. This is your oral. Now you can look away and ignore me, or you can engage and remember everything that you studied over the semester and give me a straight answer. So what's the most important variable using the Gordon growth model that would cause the stock values to drop? The number 1 variable in the Gordon growth model that would cause stock values to fall. Okay, that's another. Well, that's the Fisher equation. We're talking Gordon growth. You've only done it like 9 times. Are we recording?
Mm-hmm.
Yep. Yeah, so that's one. If your expected rates of return go, what? Up, down, would cause the values to go down. What would expected rates of return went up, then the values of the stock would go down. What's the other variable in the Gordon growth that would cause stock values to go down, theoretically? What's the other variable?
Growth rate.
What?
Growth rate.
In?
Discount factor.
In what? The growth rate in what? Now you can guess or you know. Okay, it doesn't help to guess. Although I do give you credit for guessing because at least you said something. Right? So that means you're trying. Expectations in what? Growth rate in what? Using the Gordon growth model. What would cause the value of the stocks to go down based on some type of expectations of growth rates in what? Now, can you look it up on your computer since I basically fought my tail off to get you guys computers and to be able to study in a lab? I didn't do it so that you could just, stare in the air. I wanted you to engage and look it up and tell me what expectations and growth rates would cause the value of the stocks to go down. In what? In what? I'll take it. Dividends. What other cash flows could you use that we went over in class, that you went over on the final, that you went over on the midterm, that you went over on the quiz, that you read in the book, that you wrote in your homework, that you wrote in your extra credit?
Expected.
And what's an expected growth rate? They give me another cash flow other than dividends. What?
The discount.
Yeah, the discount rate is your expected return. The perpetuity is the Gordon growth rate, so there is a perpetuity in the growth rate and the cash flow. I'm looking for another cash flow other than dividends that you could use to value securities such as stock. What else could you use? Do you have your, what? You could use the Gordon growth model to basically calculate the terminal value, but what are you using? What do we use when we use, Goldman Sachs. What did we use? Do we use dividends? No, we used what? Got it. Okay, now we can move on. All right. See, it's not really that hard. It's really not that hard. You guys forget quicker than you think. You need to remember everything that you see within your program. Every class, every minute, every lecture, every note, every problem, you have to memorize everything and remember it, okay? Because you're gonna be asked, all right? And they're gonna assume you know, okay? PowerPoints and deliverables, I think we're missing a couple people tonight. I always find that interesting, that people don't show up to the final. So you've all should have gotten your grades. I've been available for you to review your grades to make sure that you were on track. If you weren't tracking in the class, I gave you back your deliverables and basically gave you an opportunity to rework your work. I don't know any other professor that allows you to do that. Any other professors allow you to basically work with deliverables and resubmit work for credit? No. Okay. So I don't know more of what I can do. And then the Big Short, the movie, we hopefully you've all completed that. We watched it that one night when half of you left, which was a great movie. And then I'm going to do the course review, the exit lecture, and then you're going to give me your deliverables. Okay. I used to take the deliverables earlier, but and then do the exit lecture, but half the class left. So I decided to stop doing that because I was getting all upset. Oh, so give me, where's the barrel of oil right now? Where's oil trading? Do we care?
Yes.
Absolutely. Where's the barrel of oil trading right now?
52.24.
Where was it 6 months ago? Yep, 83 bucks. So it's down 22%. So if you're Russia and Venezuela, God help you're not Venezuela, and other oil producing economies, you just saw basically your revenues. Your revenues that you get from your exports dropped 22%. I do believe that if this continues, that some of these countries will default on their sovereign bonds and it will create a sovereign bond fiscal crisis around the world, and it will contage into a global financial crisis. But, you know, what do I know? Gold per ounce. Where's gold per ounce?
12.49.
Is it up or down? Give me one factor. And what is gold anyway? Is it a financial asset, or is it a commodity, or what is it?
Commodity.
It's a commodity. So if gold prices are up, what does that tell you about?
Interest rates down. Supplies down.
Gold is a commodity, and if gold prices are going up, what does that tell you about?
Dollars going down.
So-
No.
Well, supplies.
Yeah, but what does it tell you about what? If gold prices are going up, what does it tell you about prices?
Supplies down.
Not necessarily. What would it tell you about inflation? Gold prices are going up, what does that tell you about inflation?
Inflation's right.
What does that tell you about inflation? If gold is a commodity and it's highly correlated to inflation, if gold prices go up, what does that tell you about inflation?
Inflation's
It's going up. And if inflation and inflation expectations go up, what happens to interest rates?
Go down.
Oh, really? How does that work using the Fisher equation?
They go up.
They go up. Okay. What about bond yields? Where's the 10-year Treasury yielding right now? And where was it 2-3 weeks ago and a month ago?
It's going down.
What? No, say it.
I believe it was going down.
Yeah, it's been going down. Why has it been going down? Using the Fisher equation, what's the number one variable that would cause nominal interest rates such as the 10-year Treasury to go down? Using the Fisher equation.
Yeah.
What's the number one variable that would cause nominal interest rates to go down? Using the Fisher equation, what's the number one variable that would cause? Inflation what?
Inflation rates.
Inflation? What?
Expectations.
Expectations, got it. Okay. That's good. And then where's the dollar to the pound, dollar to the euro? Do we care?
Yeah.
Absolutely. Where's the dollar to the pound? That's a tough one, because what's happening in Britain?
Oh, don't they want to go back into,
Yeah.
What's happening in Britain?
they want to exit Brexit?
They want to exit the European Union. Okay.
Can't get back.
What happened when they announced that they were going to leave the European Union? What happened to the pound?
It drops.
Exactly. It depreciated significantly, which caused import inflation. Do you think the UK is big enough to produce its own raw materials, or do they have to import basically everything?
You have to import.
We have to import basically everything. So when their currency devalued, what happened to inflation in the UK?
Good one.
Okay, if their currency depreciates, what happens to the import prices?
It's going up.
They go up. And what happens to inflation in the UK? Goes up. And if inflation goes up higher than real wage growth, what happens to standards of living?
They go down.
They go down. Okay, and they're not too happy either with Miss May, also because basically Frankfurt and Paris and Singapore and New York are basically taking the currency business that they had basically built over the last 700 years. They were basically the center of global commerce for 700 years. And now, because of populism, they are destroying their comparative advantage in financial services and global transactions. Is that a smart thing to do? Probably a stupid thing to do. Okay, and then how much does it cost us to buy a pound today? $1 per, let's use dollar per euro. How much does it cost me? You guys are totally disengaged in the back. You're like biting your fingers, and you guys are like, you know, on your cell phones and stuff like that. This is the last night, okay? And I'll tell you, if you're disinterested and you don't want to hang out, then you don't have to hang out, okay? You can just leave, okay? Because I don't need to be, you know, sit here and lecture and pour my heart and soul into this class and my career for you guys and have you completely ignore me. It's just completely disrespectful. And I don't need to go here on the last night, okay? Shit. Okay, so let's just go through it. Quantitative statistical analysis, that was the first thing you did the very first day you walked into the class. I handed you a statistical pre-test. Do you think that you're going to be applying statistical analysis within a big data environment with any job that you go to?
Yes.
Yeah, they're all going to be looking for experience in R, SQL, Python, Excel. They're going to be looking for it. It's all on every single job thing now, okay? So you need to understand the statistical analysis. You got to understand large data sets. You got to understand if you normalize the data and filter the data, and you normalize the data, you're going to get normally distributed data sets. And if you have normal distributions, you can apply mean variance analysis. You can apply statistical analysis to pull the information from the data to be able to make decisive business decisions and know that the decisions that you're making are correct. That's what they hire us to do, right? We calculated geometric and arithmetic means, and we know the arithmetic means have a problem because there could be outliers in there. That's why you got to filter the data to get rid of the outliers. We talked about skewness and different types of distributions. If you go to graduate school and you start taking statistical analysis in grad school, you're going to be learning simulation techniques. If you're not already learning it already, and you got to understand basically the distributions of the data sets that you're working with. Because if you're applying normally distributed statistical applications to binomial, skewed, Poisson, or other types of distributions, the information that you gather from the data is not going to work, okay? You're getting the wrong information. So that means you're going to be making bad decisions. And you're not going to last very long if you make bad decisions. We talked about central tendency, mean, median, modes, and if the mean, median, and modes basically converge on each other, you know you have really strong central tendency, which is a good thing. Data analysis, we looked at data observations with the box plots and the stem leaves. Those are data visualization techniques to quickly be able to visualize the data and look and see what the skewness and those types of attributes are along with the data. We looked at volatility. When you hear volatility, you think of risk. And when you hear volatility, you think of variance and standard deviation. We talked about, for actually a fairly long time, model building. How do you build models based on economic or other types of factors to be able to build regression models to be able to forecast the future? If you can forecast the future, you're going to be extremely valuable. But you got to understand the factors, both micro factors, macro factors, that should be in your models so that you can then forecast those factors and forecast the future and forecast whatever you're trying to forecast. We looked at time series regression analysis and cross-sectional regression analysis. And yeah, why don't you turn off your computers and turn off your cell phones and put them away? So why don't you turn off the computers and turn off your cell phones and put them away? Put away your computers and stuff. Because they're just distracting. You could use cross-sectional regression analysis when you don't have enough data. And then once you do get the data, you can then apply time series regression analysis. So cross-section's extremely important when you're trying to build inner models until you get enough time series. We looked at coefficient of variation, which is the standard deviation divided by the expected return. And if you flip it, you get the risk-adjusted rate of return. And if you take the expected returns and take out the risk-free rate, divided by the standard deviation, you get the calculation. Okay, so you're always normalizing the data, and you're always using variances and standard deviations to control things. So once you decide if you're going to want to grad school, which I know a lot of you have, because I've helped a lot of you go to grad school, at least your peers, because I think I wrote like 5 recommendation letters today. I write a lot of letters for you guys, okay? And your peers. We talked about covariance and correlation, particularly covariance and correlation in the portfolio standard deviation equation. And if you get high correlation and high covariance, you're going to have a high standard deviation. If you have low covariance, low correlation, you get diversification and you lower the portfolio standard deviation. All businesses, all portfolio managers, both fixed income, equity, and people who build companies usually have some kind of diversified strategy where their product lines or divisional lines, where the portfolio, the stocks in the portfolio, fixed income in the portfolio, real estate in the portfolio, they're adding assets to the portfolio that have low, no, and negative correlation with each other so that they can diversify the portfolio and get rid of the unsystematic risk and only leave the systematic risk, which is measured by the beta, okay, based on your capital. We talked about internal and external validity. Internal validity is you got to get past the people inside your firm. The people that you work with are going to have to buy off on your model. And they're going to ask you a lot of questions. And I was talking to a guy today who's one of the top guys at Christian Wakefield in San Francisco, or actually he's in Walnut Creek, but he ran the Hewlett-Packard portfolio, corporate portfolio for years. And he was amazed. He said exactly what I've been telling you all semester. Is when you make these presentations. Did you get this? When you make these presentations, they're going to look at every single thing in your report, every single thing in your PowerPoint presentation. If there's an error in it, they're going to totally roast you. Period. They love it. They'll just roast you. Okay? So I'm telling you again, don't make any mistakes in your PowerPoint presentations or in your reports, or you'll get roasted in front of the investigator. Guaranteed. They love it. They love it. External validity, does your model adhere to peer-reviewed journal articles and the literature and theory that has basically been produced prior, so it's consistent, and you can cite the peer-reviewed journal articles as you're making the presentation to validate your model. Systematic, unsystematic risk, systematic risk, systemic risk, systematic risk, political risk, economic risk, market risk, all the things you can't diversify. You can diversify the unsystematic, the business risk, the real estate specific risk. Those are the factors that you can diversify with. We also looked at financial ratios. We looked at the book. We applied the financial ratio analysis. If you did, in your application to Goldman Sachs, I taught you how to calculate the peer group financial ratios, the weighted averages, and the assets, factors, weight them, financial ratios, and then compare the target firm's financial ratios to the direct competitor, your peer group in the industry, and then give the conditions and come up with an overall financial condition and position of the firm based on fundamental financial ratio analysis. We talked about WACC, weighted average cost of capital, and CAPM. What is the CAPM? What's CAPM?
Capital asset.
Yeah, what's the equation? Remember you tattooed it on your ankle? You never forget it. You never forget me. What's CAPM? What is it? You all should be on the computer.
CAPM or WAC?
Give me the WAC. I mean the CAPM. Give me CAPM. I had one of my students walk into an interview the other day. We asked him what CAPM was. We asked him how to calculate the standard deviation. We asked him about current events. He said, I felt totally confident when we went to the interview today. He was totally prepared.
Risk free rate plus beta times return on the market minus risk free rate.
Excellent. We learned about intrinsic valuation methodologies, perpetuity, Gordon growth, multiple and discounted cash flow. And now the different intrinsic valuation methodologies are appropriate for whatever you're trying to value. So if you're evaluating an established firm, you're probably going to use discounted cash flow. If you're using a startup company, newly went IPO, you're probably using the multiple approach. You're probably not going to use Gordon growth or perpetuity, but you will use Gordon growth and Gordon growth and perpetuity interest rate in calculating the terminal value when you do the DCF. We talked about unorthodox monetary policy and the political effects on discount rates. Which you witnessed, you haven't been around really long enough, but you have been alive for the last 10 years, probably 10 or 11 at the time. But we had just gone through the worst financial crisis in history, borderline depression. And the Federal Reserve and central banks around the world basically responded by printing trillions of dollars out of thin air. Does that matter? The Federal Reserve prints trillions of dollars out of thin air and basically buys up sovereign bonds and corporate bonds and drives interest rates negative if you're in Japan, or negative in Germany. So if you're a saver that basically buys these bonds, you're getting negative interest rates, which means that your standard of living are falling, and you're basically paying the government and corporations for you to hold their bonds. It's a very perverse situation. It's never been done before in history, or at least not in the last 300 years that I've studied the history. Yield curve dynamics and the yield curve inverted like 2 days ago, last week, inverted the second time this year. And the yield curve's already inverted in the emerging markets. The response by the capital markets was 1,000-point sell-off in the stock market. And still volatility and convulsions going on right now because everybody knows that the yield curve can predict the stock market peaks within less than 12 months and a recessions in less than 24 months. So that's what people are freaking out about. We learned about different types of theories of yield curves, shapes, and its impact on inflation expectations. We looked at market indicators and factors impacting the markets. We did the dynamic supply-demand analysis. And what were the factors that were shocking the supply curves and factors that were shocking the demand curves that would have an effect on the asset prices for the 5 main asset classes. Trillions and trillions and trillions and trillions of dollars are being held in the top 5 asset classes, and trillions and trillions and trillions of dollars basically flow on a global basis 24 hours a day, 7 days a week, 365 days a year in the global markets. Capital is flowing mainly through those major asset classes. So you need to understand the microeconomics, which you do, because you took microeconomics. Financial product innovation, design, development, engineering. So we talked about basically the fundamental structures that corporations need to be able to innovate product. Do corporations and multinational corporations and financial institutions, do they invent a new product?
Yes.
If they don't, they're dead, right? You can't grow the revenues. You can't maximize the share prices. You can't grow the company. You can't add value. You need to grow, and you need to innovate. So there's certain requirements that all successful companies basically adhere to when they're known for product innovation and engineering. And we looked at S-curves and product adoption cycles, which are very similar to commodities, but it's the same thing in financial products. We looked at fundamental institutional foundations and factors driving innovation. What are the requirements? We looked at modern and postmodern portfolio theory. We looked at the utility curves, the efficient frontier, the capital allocation. And we know when they are all tangent to each other, that's the market basket. And at the market basket, that's the point at which you're going to get the highest risk-adjusted rate of return, the highest number unit per return per unit of risk. And you can move out the efficient frontier by selling off your bonds and buying more stock or more risky assets. You can move down the efficient frontier by selling off your risky assets and buying more bonds. You can actually jump off the efficient frontier onto the capital allocation line through the use of leverage. Or you can move down the capital allocation line off the efficient frontier through the use of lending, which is what banks do. We looked at adding alternative assets such as insurance and alternative renewable energy and real estate to a stock bond portfolio that bows out the efficient frontier. It reduces the expected return, but reduces the portfolio standard deviation even more than the reduction in the expected return. Therefore, the risk-adjusted rate of return goes up. And if you can get your investors an 8 to 10% rate of return, you're going to double their money in less than 10 years. That's the name of the game, period. we looked at derivative trading. Not only does the efficient frontier bow out, if you add assets to the stock and bond portfolio that have low, no, and negative correlation with returns of stocks and bonds, we also learned that through financial engineering, by applying the derivative contract, by writing the contracts and going short, we can also bow out the efficient frontier by the use of portfolio insurance and the application of the derivative contracts. So we can do it through financial engineering too, which is extremely helpful. We look at technical analysis. You know, how do you, I just taught one of the professors here who teaches quantitative analysis. She was basically concerned about her stock portfolio. So she asked me, do you have any trading methodologies that that you could share with me? And I said, yes. I got a moving average crossover system that basically tracks for every stock I own 10, 30, and 50-day moving averages. And the 10-day crosses the 50, and the 30, I'm either going to buy or sell based on that signal. It's a rules-based system. If you do it, you're guaranteed to make money, period. She said that's very helpful because I'm more of an emotional trader. You know, I don't really understand stocks very well. Can't really track them all the time. I say if you use the system, you'll get at least a 10% rate of return, or at least 10% on top of whatever you're making now and losing right now. You'll at least make a 10% guarantee if you follow this strategy. We looked at support lines and resistance lines. We looked at momentums. We looked at RSIs and MACDs. We looked at trend lines. We looked at breakouts to the upside and the downside. We use technical analysis. And what you've been learning mainly through the courses is fundamental analysis, evaluation techniques. We learned intrinsic valuation applications to not only firms but also securities, using perpetuity, Gordon growth, multiple approach, and discounted cash flow. We looked at problem sets on the exams too, how to calculate ROA and ROE using DuPont method. We looked at investment decision making and the investment decision making matrix and how you apply that to capital budgeting decisions. On the midterm transition, the quiz was the hardest. And then we transitioned into applications, where we focused and just worked on problems in the midterm to try to solidify your knowledge of valuation procedures, which is basically the most important concept within the book, is the capital budgeting and the investment decision making and the intrinsic valuation work that you did. Okay? So we applied the investment decision making on a venture capital, private equity, and a startup example using perpetuity, Gordon growth, multiple, and DCF. And we found out in a startup environment that the multiple was probably the most appropriate methodologies. The other ones were inappropriate or just antiquated altogether. And we looked at an established tech firm and used the 4 intrinsic valuation methodologies and came to the conclusion that the DCF, since it was a stabilized company that had been around a long time and we could do a pretty good job of forecasting the cash flows in the future, that we would use the discounted cash flow method. It was more appropriate. We looked at an established tech company stock valuation. We looked at a public real estate investment trust stock valuation. We looked at a commercial real estate development, Salesforce Tower. We didn't get into all the underwriting and the details, but we ran through the methodology at a very high level. We also did a mixed-use commercial, residential, retail, medical, biomedical, research, anchored, university-anchored project, which is Mission Bay, okay, which is Alexandria. Also on the midterm, application theory and investment decision-making, capital budgeting, and the investment decision-making matrix. I walked you through and trained you on how to move through these 4 iterations within the investment decision-making process. If you can get a net present value that's positive, you're done. Okay? If you get a negative net present value, then the first thing you're going to do is get a cost reduction or ask for a price reduction in the amount of the negative NPV. If you can get it, then your net present value is 0 and you're going to accept the project. If you can't get the price reduction, then you got to go back and re-underwrite and re-evaluate all of the assumptions that you made within your underwriting process. And if you still get a negative net present value, you only have 1 more iteration to go, and you got to calculate the value of a real call option. And the real call option needs to be equal. The negative net present value would be more than the negative net present value. If it is, then your net present value is 0, or it's positive, and you're gonna accept the project. The three main factors that drive the valuation of real call options is management decision-making, asset price volatility, and time. Those are three. And you would use a Black-Scholes method or a binomial tree as the valuation methodology. On the final, we basically continued with the application. I scaled it back because I think I extracted a lot up from you at the very beginning, so I gave you back some stuff at the end, okay? And it was basically just a continuation. So if you memorized and you learned everything, then the final was probably pretty easy for you. If you didn't, you struggled and you might have copied off others because you just still didn't get it. You really do need to get it because they're gonna expect you to have it. And then the last piece was the Goldman Sachs application. We did okay. In that, I think we did okay. There were still some issues of competency in that because I reviewed a lot of the PowerPoint presentations, and I'm still not convinced that some of you know how to do the calculations or audited the numbers because I found some errors in it. And then the formatting. For you marketing majors or entrepreneurship or digital media, finance, accounting, it really doesn't matter. It's all in the presentation. If there's one error in the presentation, then they're going to assume that your calculations have errors in it. So you got to have somebody review the presentation constantly, multiple times until it's perfect before you make the presentation. Also in the presentations, most students that I find will spend most of their time on the analysis, and then they will run the analysis up until the end, and then they'll slap it all together, and then they'll go up and do the presentation. So they're not ready to do the presentation, okay? Because they get so internal into making sure that the presentation and the calculations are correct, they forget about the qualitative, humanistic components associated with the presentation. So they don't practice the presentation, they can't transition, they forget people's names, they forget who is responsible for what section, and they basically blow the presentation, okay? You can't blow the presentation either, okay? You just can't, okay? Business has extremely high standards, and you'll be expected to adhere to very high standards because we're talking about millions or billions of people's money, okay? And they'll take it personally if you lose it for them, all right? So we put together the presentation, we put together the deck and the pitch. If you were involved with me, which a lot of you were, and I do appreciate a lot of the effort in regards to the resume, because I know a lot of people just don't have a resume, don't really know how to put together a resume, and if you don't really have any direct work experience, it's really hard to manufacture the experience. Although I was told by headhunters, people who actually do placement, that they will look at the last 2 years of your academics as work experience if you can get at least a 3.6 GPA. They'll look at it. And at a 3.6, you probably will remember a lot of the stuff that you've learned in your courses. So the methodology was to take the last 2 years of your business degree and put it into a functional resume that basically articulates all the skills and all of the knowledge that you've learned from the different courses that you took, and then lay those out in your resume to basically fill in the gap because you don't have the work experience, but you have the functional experience from your business degree that you could put in there. And then as you gain more experience, that portion of your resume starts to shrink, and then you flip it. And then you put the experience first, and you put the academics on the bottom at some point. So I think the resumes are good. You're going to need it if you're going to grad school. Okay, you need a resume. All right. So I'm just trying to front load that stuff right now. And the Career Center here is running good. So I would utilize them for the writing center for people who don't write at a business quality level, and I'm not convinced that most of you can. So I would, since you pay so much money to go here, I would pay the money. And I would leverage what you're paying for, and I would use the Career Center, and I would use the Writing Center, and I would get good at writing, okay, as fast as possible, okay? Because some companies are not going to pay for people to come in and retrain you on how to write English, okay? We used Fundamentals of Corporate Finance, which was the Wiley book. I did encourage you to buy the Wiley Plus component because there's narrated Excel spreadsheets and narrated PowerPoints. And even though that I videotape everything, for those who were struggling, should have leveraged that. It's really good material. I think it's pretty awesome. They didn't offer that last semester or years before. For people who are taking it seriously, I think it's a really good augmentation of the class. I'm gonna try to see if I can learn more about how to integrate that technology into the class, but I did make it available to you, and I did recommend it. Then we went through the book. We used the book. You actually did most of the presentations from the book in your team presentations in the chapters. I would recommend, if you do it again, that you should prepare a little bit earlier and to come in and read from the slides. It basically is extremely boring, and people just disengage right off the bat when you start reading from the slides. And edit the slides. So we learned about the role of the financial manager, the financial system, interest rates, financial statements, how to analyze financial statements, the time value of money, which is basically your future value factors, present value factors, discounted cash flow valuation, which is key, and the number one most important thing from the book. Risk and return, we did a lot of that already right up front in the statistical pre-test. Bond valuations, term structure of interest rates, we learned right off the bat about term structure of interest rates, which is also called the yield curves. Okay? And what drives the shifts in yield curves, and why are they important in determining the cost of capital, and how the cost of capital basically determines the valuations of all real and all financial assets. Okay? And we learned about stock valuation. I really focused in on that. Capital budgeting, we really focused a lot of time on that too, in different types of cash flows. Project economics, cost of capital, WACC, CAPM, you gotta memorize that stuff. The key to the WACC is if you go work for a publicly traded firm, and even if it's a privately traded firm, private firm, they're gonna have to raise capital from somewhere, and they're gonna have to pay some cost of capital. They're gonna have to take that capital, and they're gonna have to invest it in some kind of asset or assets that's gonna generate some internal rate of return. If you're investing in assets whose cost of capital is higher than the internal rate of return, your economic value add is negative, and your stock price and your company value is gonna collapse, and you're gonna go bankrupt and you're going out of business. But if you can raise capital and structure your capital structure, the liability side of your balance sheet, to minimize the weighted average cost of capital, and you can invest strategically in assets that are gonna provide you with a high risk-adjusted internal rate of return, that spread between the internal rate of return and the weighted average cost of capital, either in percentage or dollar terms, is the economic value add. And if you can maximize economic value add, you can maximize the value of the firm. And that's what the CFOs and CEO and CEOs focus on. Okay? If you've listened to any analyst conference calls, which I don't think you did for Goldman Sachs, and I did highly recommend that you listen to the conference calls, they talk about EVA, okay, as the number one metric to creating shareholder value. We talked about optimal capital structures, with the Modigliani-Miller hypothesis. A lot of firms like to over-leverage the firm. When you over-leverage the firm, you can juice the return on equity. But the problem is if you over-leverage the firm and you add too much debt, too much mortgage risk to the portfolio, you're taking on bankruptcy risk. If you take on too much of that, the bond and the stockholders will understand that and start dumping the stocks and the bonds. And as the stock prices and the bond prices go down, the cost of the debt and the equity goes up. It becomes really hard for the firm to basically reestablish itself in the future because they just lost credibility in managing their balance sheet. We talked about dividends and dividend payout strategies. If you can pay out dividends and never stop paying dividends and never stop growing your dividends, that's basically the return of capital that the investors gave you when they invested in your firm. So you're rewarding them, and they will stick with you, and they will buy your stock if you can provide them with constant dividends and constant dividend growth in the future. We talked about financial planning and growing the firm. That was all kind of redundant in capital structures. And then in chapter 2021, we talked about options. We were talking about options the whole class. We were talking about derivatives the whole class. Okay, because derivatives and options and derivative contracts are extremely complex. So my thesis is, why don't you bring the most complex concept right up front at the beginning of the class, not at the end of the class? Because if I did it at the end of the class, you would forget it. If I do it at the beginning of the class, you'll go over it so many times, you'll remember it, okay? Then what I also did, let me give you a little bit of it. What were the channels of communication? I was always available to you. If you texted me, I texted you. Called me, I called you. If you emailed me, I emailed you back. I basically posted to the best of my ability, you know, all the resources that you need on the course website. I provided you with announcements. I provided you with emails. I pushed information. I pushed content. I pushed out information to give you the resources that you needed to excel in the class and learn the material, and to be able to respond to me, you know, and to know when I was going to be in my office hours and when I would be available. And if you wanted to set up an appointment, you could do that too. I never spend enough time with my students, okay? Never. Because I think part of the issue is that students look at professors as professors. It's that slave master mentality that you guys have been indoctrinated in and basically conditioned in a conditioned response over the last 16 years. You've never been in the real world and you've never worked with a managing director or peers or people in a team on a one-on-one basis as colleagues, basically working together to make sure that we all succeed. You think you can get over on me, you're not getting over on me by basically not coming to see me. The way that you do it when you make the transition into the real world is you're going to be working with people on a day-to-day basis. You're going to be talking to your boss every minute of the day. They're going to be talking all the time. You're going to be working in teams. You're going to have to build trust within the team. You're going to have to build capabilities and competencies, and that they're going to be basically have to rely on. And that's the way I like to teach my classes. Okay? I don't like being the professor. I like being the managing director of a small company and working one-on-one to train my colleagues to basically be the best people that they can professionally. So that was kind of my goal. What else? And that's it. Right up top. Any questions or comments in regards to the class? I know I probably didn't spend enough time on the books and probably talked too fast and used a lot of words and a lot of language that you didn't understand. So in some of my other classes, I've basically come to an agreement with the students that I would probably slow it down in the future if you guys read the book. Okay? Because some of my top students say the same thing. I really didn't understand what you were saying for a significant portion of the class. You come in and you start talking in a certain vocabulary that I really didn't understand. I was scared to say, hey, Professor Susie, can you explain that? And that's part of your responsibility to stop me, slow me down, and then ask questions. If I don't get questions, then I'm going to move on. Okay? And she also said that once I started reading the book, I came to class and I started understanding exactly what you were saying. So again, part of it is taking responsibility for your own education, which you should, because you're spending a lot of money. So you might as well get the most out of it. If you're not getting the most out of the education, then you're wasting money and you're wasting your education. This is perfect timing because a lot of you are juniors, which basically means you have 2 years to get it together, or a year and a half, to raise your GPA to 3.6 and take your education extremely seriously and get the most out of it so you can make the transition into the real world and be totally prepared. If you don't, it's going to be hard. Okay? It was hard for me. It was hard for me to make the transition, but I was lucky because I had people around me that supported me, believed in me, and were willing to invest the time in remediating some of the deficiencies that I had. And then I decided to continue to go on and get multiple master's degrees to distinguish myself amongst the others because I was behind all of my colleagues. Okay, and I'll talk about that a little bit in the exit lecture. So any recommendations or comments on the class? Now, you're going to be sitting in a meeting. You're going to be sitting in a meeting with a lot of executives, and they're going to ask you questions, and you're going to have to say something. If you don't say anything, you're going to be in trouble. So do you have any critical comments or suggestions on the class? What did you like about it? What didn't you like about it? Or not what you like, how can I improve it?
I think that you should get fast at a slower pace because we other students understand further.
Yeah, and I did start recording, doing the videotapes too,
Yeah,
to help
that's
remediate.
my study, like, every time.
Yeah, my problem is I think really fast. You know, I'm a really fast thinker, you know, and I talk really fast. So, yeah, I appreciate that, but tell your colleagues to raise their hands or speak out and say, can you please slow it down? I won't take it personal, I'll appreciate it. But you gotta speak up.
Is that not like, just like, oh, 1 or 2 times that I have to go home and watch the video on here?
Yeah, but that's not bad. And what I found too, is that I write notes. I used to walk out of all my classes with 20 pages of notes. I don't see you guys writing notes, so you can review them. Some of my top students, they take copious notes, and then when I ask questions, they flip to the notes and they answer all the questions. So I don't know how you're retaining it, unless you have a photographic memory, or some kind of mental superiority, you know, to be able to basically absorb all the information and retain it and then be able to use it. You need to take notes. You need to take notes. That's how you learn it. So, yes, if you guys take notes too. You gotta take notes. Anybody else? I don't mean to be defensive. Go ahead.
Well, overall, I love the class. I love the way it ran. I would just say more incorporation with the book in regards
Yeah.
to following along. Maybe like an extra assignment or 3 or 4, just so you make sure that you can go through, read the chapters, and something.
Yeah, that's what I did with the extra credits.
Yeah.
Homeworks. Usually in my other classes, what we would do is all of us would get up on the board and we would do the problems. So we'd spend the night doing the homework problems, and then you would be doing the homework problem presentations. But it's really hard to do that here because I don't have whiteboards around all of the boards. So it makes it a little hard to do that stuff. Okay, and yeah, I should probably do more of that stuff. Probably do more of that stuff. The book is a resource. I like teaching my material. So yeah, I'm getting better. Okay, I'm getting better.
So I really liked the class as well. I liked it because it was useful to my future, unlike all my other classes, where I just learned things that I'll never use again. But the one recommendation I have is that instead of doing the PowerPoints in class, because I don't think a lot of people really pay attention
No, they
when
didn't.
we do the presentations, maybe just doing the homework problems, and then if you didn't understand how to do them, going over that. And then if people want to go ahead and read the chapter on their own, they can do that on their own time.
Yeah, well, part of that making people do the PowerPoint presentations is forcing them to learn at least the chapters.
Yeah.
Okay, so I'm trying to get as much to stick as possible, and then because I'm not convinced that you read the chapters. If you didn't do the PowerPoint presentations, you wouldn't even read the chapters, so you wouldn't really even learn it. So you'd miss a lot of content. So I'm trying to figure out ways to get around, lack of motivation. I just think it's a generational thing, and I think it's just age, where you are in your, and you overload yourself with so much stuff, you're always pushing to try to graduate on time, and then also have a life outside, so it's a lot to do. So I'll take that into consideration. Thank you.
On the videos online, so on this, like when you do the announcement log, it gives the class like along with the video.
Yeah.
But on the like YouTube page, it's just the name of the class. So maybe like put like class 2 or whatever next to it, because when you look on like the page, if you're looking at like multiple ones, it's like a little confusing figuring out like which one's like which in order.
Yeah, especially the ones where where the team presentations.
Yeah.
Yeah, I could probably do a better job, but that just needs more time.
Yeah.
For me, and videotaping is not easy. I gotta upload like 10 presentations a week, and then push them out to, 5 classes. That just adds more time. So I'm just in the process of pushing out the material at this point. I'll try to figure out some kind of method so that I can, add more of the labeling to it, so it becomes easier to know what's in the content. That's on my list of things to do, and I've heard that a couple times. let somebody else talk, and you say nothing, it's gonna come back to haunt you, I promise you. You'll be in a meeting, and you won't say anything, and some person will be the talkative person, and they'll create groupthink, and they will drive the decision in one direction, but you'll probably think it should be going in another direction, and you won't say anything, and the project will fail, and you'll get fired with the person too. Because you were part of the group, and you didn't say anything. So be careful.
I thought it was really helpful that we got to get our tests, like our deliverables back so we could see our mistakes and then recorrect them so that we're learning from our mistakes and learning what we're doing wrong because most times.
Yeah, that's what I tried to, it's a lot more on my side. When I see other professors using Scantron, multiple choice exams, I just want to get sick. Because I'm not really convinced that that is a true method of actually learning. But I think putting together multiple assessment tools in deliverable packages, which is replicated after the real world, and then giving you opportunities to go back, correct, and see how to learn from your mistakes, so that you're learning the material so that we can progress. That's really, I think, the way to learn, and that's the way it's going to be in the real world. So I'm not convinced that multiple choice Scantron exams are really it's like 50 years old. It's great for us because we can just send them through the machine and it corrects them and we're done in half hour. But I spend hours on your work, and I also have a team of trained TAs who have taken my class that were the top students, and they know exactly where to go to get the information. They know exactly where most of the students make their mistakes, and they'll give you feedback. I also hired 4 more TAs out of my own pocket. I spent my own money getting you the resources that you needed to be able to get the memos, okay? And then for me to be able to grade all those exams and get them back to you on time with comments, in areas where you should be focusing on. I don't think any other professors do that, or bring you pie. What else? Anything else?
What was the 10, 50-day cycle you were talking about?
The 10-day, the 30-day, and the 50-day moving average crossover system. It basically states that when the 10-day crosses the 50-day, either up or down, that's basically a buy or sell alert. And then when the 30-day crosses the 50, along with the 10-day, that is your buy or sell signal. And just as long as you adhere to that, you will make money. It's a guaranteed money machine. I can show it to you sometime if you're going to be managing your own money, which I highly recommend. If you don't manage your own money, and I'll talk about this in a minute, if you don't manage your own money, somebody's going to steal it, guaranteed. Or you're not managing your money. So, any other comments? Yeah.
For like keeping track of your grades, for like your, the letter grade you give us with our deliverable, would that kind of be like an indication of what?
Yeah, if you work with me and you kind of followed along the methodology throughout the class, I gave you back, deliverable 1 and 2. I basically identified the areas in which you were weak. I basically said, okay, go back, correct these things, go back to the video, correct it, and if you hand it to me back into me, and you still are having some problems, then you come sit down with me and I'll show you where you made your mistakes, and I'll still give you the tip. But if you didn't do that, then you didn't do it. Okay. So I was looking for you really. A lot of it is persistence, perseverance, and work. Everybody's really smart, okay? But it's the person who works hard, that's going to be the most successful. So I was testing you to see if you were willing to work hard. And if you were, you're fine. Okay, anybody else? All right, so let's do the exit lecture. There's 9 modules in the exit lecture. Okay. I designed the exit lecture of the last 12 years. But I did it in modules. I did it separately. I would have students that came up to me and said, Professor Souza, can you help me at blah, blah, blah. They'd give me some case, and what they were dealing with. And it happened over and over again. So I started to build these models based on psychology theory and finance theory, other types of theories, to basically try to answer a lot of these questions. And And my demographic that I target when I do these life coaching, or however you want to call it, is basically juniors to people who are basically 3 to 5 years out of college. That's kind of my target demographic. As people start to get older, I really can't help them because they're basically on their own track and they're old enough. And, my value doesn't, I think, resonate as much. But I did have a woman who became the president for Commercial Real Estate Women in San Francisco, which is one of the top, global women's commercial real estate organization in the United States. And we were the San Francisco chapter. And one of my colleagues called me up and said, would you become a board member on this all-women's organization? And I turned her down at first, but she was very persistent until basically I said yes. And then 2 years later, after working with a lot of these board members, one of them became the president-elect and said, Larry, would you coach me? Will you coach me? I think you're amazing. Will you coach me? And I said, that's amazing too, because I've never had anybody of your stature come to me and ask me for your help or for help in the coaching. So I said, will you give me a couple weeks, to pull something together, and then I'll come and I'll make the presentation to you. And if you want, I'll follow you through, but I think the presentation is going to be enough for you. But if you want to follow up after that, I'll do that with you. So over the 2 weeks, I basically pulled together the first 5 modules to the system that I'm going to present. And then after I worked at New York Life as an investment advisor, I added in the financial advisory strategy at the end, because I realized that a lot of you at your age think you're going to get the money, but you're not going to get the money because you don't even know where the money is in most cases. And somebody's going to steal it from you. And the number one person that's going to steal it from you, if it's not your relatives, it's going to be the federal government, or the government's going to steal it. So I needed to add in a couple more modules to bring in the intellectual infrastructure that you would need to be able to protect yourself from people stealing your money. So I did that. So the first module is called the nomenclature of knowledge. And we are in the best school in the university because we're in the business school. And the business school is cross-sectional. It's multidisciplinary. If you were studying physics and chemistry, you're really focused in the physical sciences, and it's very narrow and very deep. But the social sciences encompasses the business school. And the business school is in the social sciences along with political science and international relations and economics and a lot of the cross disciplines that you're learning in your business degree are reflected in the social sciences. And the social sciences are awesome because it's so complex. We're dealing about human behavior in institutions, which makes it fascinating because it's really hard to forecast where the future is going to go. But us as social science majors, we have to understand a little bit about everything and a lot about what we're good at. And what I came to the realization is the number one variable, the dependent variable that you want to learn how to forecast is the value of equity. The value of your equity. The value of the equity in your stock portfolio. The value of the equity in your real estate portfolio. Your kids in the future are going to be your equity. And your family is your equity. And basically, factors, external factors in the marketplace will affect the value of your equity and the value of your portfolios that you will have no control over. But if you understand how the world works, you will be able to see it coming and then to be able to move out of the way or move in the way of the benefits associated with those outcomes, with those factors. So the basis, the first body of knowledge you have to understand, which is the basis of all civilization and all business, is accounting. You have to understand the financial accounting, and you have to understand the managerial accounting. And then roll that accounting up into the financial ratios, into the cash flows, into the statements, to then go out and raise the capital. And then raise the financial instruments in the finance realm. So you have to understand finance. And then the finance and the accounting are in the economic realm. So you have to understand monetary policy and fiscal policies and the factors that affect monetary and fiscal policy, i.e. interest rates and tax rates. You have to understand political science and the policy formulation process and how policy either comes up from basically the masses, or it's formulated and comes down from the executive branch, or is initiated from either two branches. I know this might be foreign for some students, but we're talking about democratic capitalism here, not basically communism or some type of socialism. I'm talking about democratic capitalism or liberal democratic capitalism as the model. So policy is formulated through the political science process, and then a policy is enacted, then becomes law and administered through the public administration or the bureaucracy with intended and unintended outcomes. And you are going to be affected through positive or negative externalities associated with these policy outcomes. The thing that I find fascinating is a lot of us focus down here in this realm because it's really easy to gather the information and run the net present values. What we don't study is really the political science, the law, public administration, and we don't really understand the basis of these political philosophical institutions and how they actually originated through theology and philosophy. Our system of civilization here in the United States is a Western civilization. We basically modeled and built our society around the Western philosophers, where others have based it through theologies of Shintoism or Taoism, other sorts of theological constructs. Basically governs their societies. So if you understand the theology and you understand the philosophy, then you'll understand the politics and the economics, and you'll understand how those institutions affect the value of your real estate, your stocks, your bonds, and your own value of your own portfolios. There are multiple variables in each one of these models. These are all models. In social sciences, there's 50 variables in each one of these models. So 7 equations, 50 variables, it's a 7 by 50 factorial. It's impossible to calculate unless you have big data applications and you have infinite data processing, which we do pretty much have now. When I built the model in 1996, there was no big data. There was no data analytics. There was no supercomputing or parallel computing or quantum computing. That wasn't even invented then. Okay? But now you can solve this equation simultaneously and program it and do it. But how the way that people solved this problem before, simultaneously, understand how the world works, and if something happens, what the impact's going to be on the value of the equity, is they programmed it into their brain. Because the brain is the most powerful supercomputer that can transact up to 1 trillion biological transactions per day. So your brain is the most powerful supercomputer ever designed. The question is, do you know it? Do you understand it? Do you recognize it? Do you understand that you have infinite data processing capabilities, infinite storage capabilities, to basically store the data, pull the data, do the analysis, create information, restore the data, so that when something happens to you and you're confronted with a decision, you can retrieve the information in the data, process it, make the decision decisively, and know the decision that you're making is correct. That's what you have on your head. And coupled with supercomputers now in your hand, and supercomputers as desktops, laptops, and tablets, because the compute power has basically gone up about 1 million-fold in the last 30 years. You now, with these technologies in your hand and the understanding of this as an operating system, you are the most powerful generation on Earth ever birthed. So the question for you will be, how are you going to use this information? How are you going to use the technology? Will it be for good or will it be for evil? That's the decision you're going to have to make. And that'll be a moral and an ethical decision, and you will all be confronted with moral and ethical decisions. So the major takeaway, or actually what makes this all work, is linguistics and language. We all speak English. It's the business language of global finance. So we all speak the same language. Culture, communications, now technologies are standardized. If you look at us all around you, look at everybody around you, and then go overseas to most metropolitan areas, we all basically dress the same. We all speak English. We're all basically from the same culture. So it's all standardized. That's what makes it extremely efficient to be able to apply this model, because we are basically, it's standardized. This model of learning and knowledge does not work in Mosul, in Baghdad, in other parts of the world that have been completely destroyed. Look at the pictures of Mosul. They're destroyed. There are no universities there. There's no learning. There's no architecture there, which is the ultimate reflection of civilization, is the architecture. There's no architecture there. There's no learning. Nothing. It's there. If you are here in the most beautiful city, in an environment that's totally conducive to learning, and you are the most, have the most opportunity of any generation, and especially here at this university. So don't take it for granted. So the major takeaway from this is it's a machine learning, it's machine language, artificial intelligence. It's basically how the world works. It's a very complex system of institutions and equations that need to be solved simultaneously. There are variables in one equation that are also in the other. So any movement of one variable moves the equation in the other variable, other equation. It's multi-institutional, it's a simultaneous equation solution, it's multiple regression, it's big data, it's biological processing with infinite storage. This is your operating system going forward. The next model is organizational diagnostics and navigation. You're going to go work for a company. What company are you going to go work for? You're going to be talking to people within the company. Who are these people? Do you know who the person is that you're talking to? Do you know their background? Do you know where they grew up? Do you know where they, what their education background is? Do you know what level of the organization they are? What is their title? Are they down here in the organic team virtual realm working on projects cross-functionally within the organization? Are they managers overseeing teams within a broader functional line or product line within the organization? Are they an executive vice president or a managing director? Are you talking to the president, the CEO, the COO, the CMO, the CFO, the CTO, the chairman of the board, or one of the board of directors? Depending on who you're talking to, you're going to have to change your linguistics. You're going to have to change the way you talk to them. You can't talk to them the way you want. You got to talk to them the way they want, that they're accustomed to. They're not going to have patience. You need to talk to them in precise language to them and be able to understand what they say and be able to communicate that value to them directly. So you need to be able to talk cross-functionally, and you got to be able to talk upward and downwards within the organization. You got to know where you come in to the organization. And then if you have aspirations for upward mobility within the organization, you have to plot it, because nobody's going to give it to you. You're going to have to strategize, both tactically and strategically. How am I going to move myself up the organization? Do I have to move laterally before I move up? And if I try to move up the corporation or up the organization, and I run into bottlenecks or glass ceiling based on education level, race, gender, then you have to make a decisive decision. Do I stay there or do I leave? And I wouldn't stay there. I would leave. So you have to be ready to go. You got to be constantly plotting. You got to be constantly ready to go. Because if you're confronted with bottlenecks or a glass ceiling, you got to leave. If you stay, your career is just going to deteriorate. You're going to be myopic, and if they treat you like that in the organization's probably going to fail at something, or get bought out, or fail, because they're not treating you right. So the major takeaway from this is you got to be able to do an organizational scan of the organization that you're going into. You got to understand the organizational design based on the industry in which the company is in, and what their comparative advantages and disadvantages are. Where are they in their life cycle? Is it a startup? Have they been around a few years? Or have they been around a long time? You got to be able to determine your location within the position, within the division of the organization. You got to be able to understand how to navigate, to arbitrage your human capital, and to build human equity, human capital. Am I working in this position, in this division, in this company? Am I accumulating human capital, human equity that I can arbitrage either through promotion or getting out of the organization and doing it for a competitor or somebody else? You got to be willing to move. And when you move to another company, you got to execute flawlessly. You can't flamethrow the organization and everybody behind you. You got to leave and exit, because you may go back to the company at some point in time in the future. So you can't burn bridges. You got to be able to communicate at a vertically within the organization and horizontally within the organization. And you gotta be ready to go. And if there's an opportunity, you go. And you go ahead and have it. The next model, because I get it a lot from people as they say, how did you do it? How did you, work 15, 20 years and get 2 undergrads, 5 masters, a doctorate, work 25 years, do all the things that you did? I had a plan. It was totally planned. Okay? A lot of people think it was random. Oh, Larry, you like school. You must like school. You got all that school. You like school, don't you? It's like, yeah, I like school. They didn't even understand what I was doing because I couldn't tell them I wanted to be a financial engineer because they didn't even know what it meant. They didn't know what it took. So I was wasting my time trying to explain it to them. And actually, in most cases, what most people will do is they won't even listen to your passion and what you're trying to articulate to them because they're projecting their own insecurities on you. And they're basically framing you and what you say within their own confines and their own constraints. So you're basically wasting your time trying to convince somebody what you're doing. What you do is you basically find people that advocate for you, love you unconditionally, that believe in you, and you surround yourself with people like that around you. If you have negative people around you that are obstructing you, or saying negative things, or projecting their negativity on you, they're dragging you down and pulling you back. And you've got to get around it. And you got to either tell them what they want to say, tell them to get out of the way, or tell them what they want to hear and go around it. You can't have them getting in your way because they're slowing you down, and you don't have time. You don't have time. So you got to have a plan. And the first thing you do is, this is basically a 20, 30-year plan. First thing you do before you set out a plan is you got to figure out what's important to you, what you're willing to sacrifice and what you're not willing to sacrifice to be successful. What am I willing to sacrifice and what am I not willing to sacrifice? What time am I willing to give up and what time am I not willing to give up? Time is your enemy, time is your friend. You got to figure out what's important to you and what you're willing to sacrifice and what you're not willing to sacrifice. Is it school? Is it your job? Music? Sports? Friends? Family? What are you willing to sacrifice? What are you willing to not sacrifice? That will basically set up what your choices will be in the future. The bachelor's degree, and what you're getting right now, the bachelor's degree. The bachelor's degree is just the ticket to get into the ballgame. I'm going to use a sports analogy. I'm not a big sports person, although I like to serve and watch rugby, because I played for a while, but I'm going to use the sports analogy. The bachelor's degree is just a ticket to get into the game. The goal is to become a professional player and get down on the field and be a professional player. First thing you need is you need the bachelor's degree. Some people, you can get through it in 4 years, maybe a little bit less. Some people, depending on your situation, may take it to 7 years, maybe 10 years to get the bachelor's degree. Once you get the bachelor's degree, you're basically in this bardo state, this interim state, this apprentice or associate state in here. This in here could last between 3 to 7 years. What you're trying to do within this time period is to gain knowledge and experience and credentials and licensing to basically get you into a really good school, okay, a really good MBA program. So you have to be plotting this out right off the bat. You can't do it at, oh, I want to go to grad school. Well, you should have been planning that all since your freshman year in college, okay, or even in your when you were in high school. You should have been thinking about it because you got to be really preparing for it. The tracks are pretty straightforward in here. If you're a CPA or a accounting major, because you're going to go get your CPA, it's going to take you 5 modules, maybe a couple years to do it. So you're kind of on a track, and it's pretty easy to do the track. And then if you're in finance, you're going to get the chartered financial analyst designation. That'll take about 3 years. If you're in computers or project management or product management, you're probably going to get your PMP certification or your Microsoft or some other kind of certification that will basically tell people that you have competencies in data analytics or project management or program management. If you're going on the wealth advisory side or the real estate side, if you're going into real estate, you got to have your license. You can't sell real estate without a license. Same thing with securities and insurance. You can't be a wealth advisor without the licenses. You just can't. So in this period, you're getting all of that training, all of those licenses to basically set yourself up to go to the Ivy League, okay? That's the goal. Either a tier 1, tier 2, it doesn't matter, get into the best program that you can. Professor Souza, I can't afford to go to the Ivy League, really? You can't afford not to, okay? And the money doesn't really even matter, because that's all that matters is getting into the best school. If you get into the best school, when you go away for your summer internship and you get the job offer, they will probably pay for the last year of your business school, and they will set up some type of compensation or bonus structure where they may buy out your first year altogether. So it doesn't really matter. It's acing the GMAT. It's getting really high grades in your undergraduate program. It's basically befriending and becoming partners with your professors so that you have the 3 letters of recommendation. And you write an amazing statement of purpose so that you can get into the best program. Because the best program, basically the best people and the best companies recruit from the best schools. So you'll never have to worry about getting a job because they won't let you fail. They will be there always to pull you in and make sure you don't fail. So you gotta plan this stuff. Once you graduate, you're basically gonna move into an associate or an apprentice program. Okay? You're gonna be working under an executive vice president or a managing director or a EVP or VP. What's great about that once you get out here is these people are extremely motivated and upwardly mobile. They're trying to get into the C-suite. If they can't get into the C-suite, they're not going to do it inside the company. They're going to leave the company, and you're going to move up, and you're going to take their position. That's how most people get their promotions, because they're underneath an extremely competent individual that taught them everything, and you use them as a role model, so that when they left, you moved up into their position and took their position. And then the other people moved up into the C-suite. So if you do the financial, if you do the calculations on how long it takes to execute this strategy, which basically tells you you need to be planning, is the bachelor's degree is 4 to 7 years. This Barno State in here could be 3 to 7 years before you get enough experience to go to a good school. Then you get into the 2-year program. Now you can do executive MBAs at Wharton or Cal, so you don't even have to leave your job. Now you can do Ivy League educations through executive programming, which I didn't have when I was at your age. So that's 2 years right there. Then you got the associate position, 3 to 5 years. Managing director, that could be 10 years right there. And then you could spend up to 10 to 20 years as an executive. So basically what you're looking at right now in front of you is at least 30 to 40 years of a career, okay, of a career. And here's the amazing thing about it, is if you can make on average about $100,000 a year, on average per year for the next 30 to 40 years, the total income that you would generate is $3 million to $4 million. And that's totally doable, right? That's totally doable. So theoretically, all of you right now sitting in those seats are worth at least $4 million. You are worth $3 to $4 million. Now here's the sad part about this story. That was the good part of the story. The sad part of the story is, what happens if something happens to you? What if you die in a car accident, an airplane crash, you get diabetes, Crohn's disease, you get cancer, and you die? Do you think people in their 20s and 30s die? Yes, they do. Yeah, they do. I'm just telling you the truth. This is the reality check. Nobody's going to tell you this stuff except for me. You'll never hear it from anybody, except maybe when it's too late. So what's going to happen is, if something happens to you, if something happens to you, everything that your parents invested in you is gone. Because your parents have worked all of their life to get you here, okay? To get you here. And they're banking on you to go help them in the future, help to take care of them, okay? And your family, if you already have a family. So basically, if something happens to you right now, your parents get nothing. Zero. Nada. So everything they invested in you, they get nothing. Now that to me is irresponsible, and it's tragic, okay? And when I hear the stories about some young people not making it, first thing that comes out of everybody's mouth is, did they have life insurance? And the majority of the answer is no. Oh, but he's like 32 years old, he's got 3 kids, and he's married. You're telling me he didn't have life insurance? No. What happens to the kids? What happens to the mom? What happens to your parents? What happens to your brother? What happens to your sister, your cousins? And the answer is really, really simple. You get $1 million worth of life insurance and you pay $400 a year for 30 years. Not a month, a year of life insurance. $400. That's beer. It's a month worth of beer, right? That's your beer budget for a month, right? A year for 30 years. If something happens to you, your parents will at least have something to pay off the mortgage, to send your brother to college, to take care of some of your debt. Get your life insurance. Get it, okay? Don't be irresponsible. You want to do a startup company? What they're going to do is they're going to, first thing they're going to do is they're going to ask you, are you insurable? Because you want $5 million from us, seed capital. You want $25 million for your startup. And what happens to you if something happens to you? You brought the IP. What happens to the company if something happens to you? I'm out $25 million. So I want at least $5 million on you. So you got to get the insurance while you're healthy, because you can't get it when you're sick. It doesn't work. I got clients that come to me all the time. Oh, Larry, that was an amazing strategy that you put together for me, 5, 6 years ago. I want to do it now. It's like, well, what changed? Well, I got cancer, and I want the life insurance. I can't give you life insurance because you're uninsurable, so we can't do it. Should have done it when I told you. It would have been cheap, and it would have been easy. And once you get the life insurance, nobody can take it away from you. So again, I don't have a time machine, but I can give my clients really good strategy, and if they execute on it, everything will be fine. But you got to be able to do it, and you got to believe in it. All right. So the major takeaways are, 20 to 30 years goes really fast. You need to plan, and you need to stay on track. You need to watch what I'm saying up here and not be focused on something else at the back of the room, because I can totally see all of your eyes. And when you're looking at the computer and you're not paying attention, I know you're just completely ignoring me. So what I would do is just listen to what I'm saying, just give you a little bit of time so that you're listening to what I'm saying, so that when you walk away from here, you're going to take away a lot of the information. Could you poke him in the eye for me? You need to turn off your computer. Okay. And if I'm boring you, you can leave. Okay. So the major takeaways are you need to plan and you need to stay on track. Do not worry about the money about getting into a really good school. Get into a really good school, finance it however you can. You should have been making money in here to help offset it. Your parents will help, that's great. Get the loans, don't worry about it, then get your employer to pay for it. Okay. Shoot for the best school, the best program. Don't let anybody get in your way. And if they do, you need to go through them, you need to go around them. But the key to the whole thing is you got to be constantly moving forward. You got to be constantly moving forward. In prime time, the prime time age is between 35 and 45 years old. You're going to make the majority of your wealth in those 10 years. Between 25 and 35 years old, you're gaining experience, and you're moving, and you're really setting yourself up. And then those 10 years is the most important. And then things will start to slow down from 45 to 55 and 55 to 65. So you really have that 10-year window. Between 35 and 45 to really make it happen. The next model is called social learning and social modeling. So this is a psychological application to career advancement or individual psychology. And what I did was I took Albert Bandura's work from Stanford University. Bandura is a clinical psychologist, a research psychologist at Stanford. He's going to win the Nobel Prize. And Bandura basically did a bunch of research on kids, and kids in video games, and kids in TV. And basically realized that kids in particular, along with every other individual, and actually B.F. Skinner made the same observations. That basically we model other people's behaviors. Either we know it or we don't. And we will model their behaviors for good and bad. We will get rewarded for the good behaviors that we model and emulate, and we will be penalized for the bad behavior that we model and that we behave. So Bandura, and I modified Bandura's model, and Bandura basically states that all of us in this room, and I myself, has an ideal self. I project out and say, you know, what do I want to be, and what do I look like, and who am I going to be in the future? And that's why we're here right now, you know, in school, is to basically give us what we need to become what we want to be in the future, or that ideal self. What we need to do is to take that ideal self and basically modify it to become the target self. The target self. And the target self is made up of other models, other individuals that we've identified that basically have the positive attributes that we want to emulate. So it's the ideal self becomes the target self. Now the problem is we're not at the target self or the ideal self right now. Here is where we are right now, the actual self. And here's our ideal and our target self. So there's a gap, there's a cognitive dissonance that creates stress, that causes us to try to close this cognitive dissonance gap. So the question is, how do we close the gap? Well, we close the gap through what is called self-efficacy, the process of self-efficacy, the process of trying to emulate these positive attributes based on these models to then try to see if we can emulate those positive attributes. The problem is that those aren't our inherent attributes or the attributes that we have been working on for years. So we're not going to probably be very good at it, or we may not have enough information or data to be able to succeed at it right off the bat. So you're going to try right off the bat to emulate these attributes, and you're going to fail. Now, here's where the key comes in right here. Ladies in the back, if you could give me your attention and not hide behind your computer all semester. Here's really the key here, is the process of self-efficacy and the process of failing is not failure for some people, because they believe that the failure is not a genetic predisposition. It's a lack of information or a lack of trying. It's lack of persistence. It's lack of perseverance. So there are two types of individuals that I noticed. There is the math and the science person that basically says, okay, I'm really good at math and science and accounting and finance. I have a genetic predisposition to accounting and finance. I'm really good at it. My parents were accounting and finance people, or scientists or mathematicians. I have a genetic predisposition for it. I've seen them apply the math and the science. They've been successful. I'm going to do it because I have a genetic predisposition to math and science. And I don't want to do any of the management. I don't want to deal with people. I don't want to sell. I don't want to raise money. I don't want to do any of that stuff. I just want to be over here doing my stuff, and I just want to do that because that's what I'm really comfortable doing. And then there are people over here who are the sales and the management people, the marketing people. You know, I'm really good with people. I'm really good in sales. I like people. I'm not good at math. I'm not good at science. I'm not good at the accounting. I'm not good at finance. I don't want to do that stuff. I'm not good at it because I got a genetic predisposition to sales and management. My parents were in sales and management. They were extremely successful. Therefore, I'm not going to do it. I'm just going to be on the sales and management and marketing side. And I'm not going to do any of the math, and I'm not going to do any of the science. Now, what I also noticed is that the top students and the top individuals that get to the top of these organizations probably came into one or the other of these areas, either through modeling of their parents or some other way. But what they did was they realized that they were weak in the other areas, and they cognitively made a decision to work on their weaknesses to become a strength so that they could be both good at the math and the science and the management and the marketing and become a hybrid individual. Those are the best people. Those are the top people. They're good at both. They may have come into it, but they used the self-efficacy. They were able to look at all of their failures as lack of information and not a genetic predisposition and do it. So here's what you get from this whole process. If you can do this all the way up to here, what happens is you obtain a persona, a personality, a presence. When you walk into a room, based on your dress, the command of your presence, the command of your language, and your communication style, because it's so precise, you will have charisma. And charisma breeds leadership. People will not follow people without charisma. Because people are not motivated by money, they're motivated by other individuals, people that they want to model, people that they want to work for, people that, other companies that they want to work for. That's what motivates them. So therefore, you end up having the charisma, the leadership, and then obtaining the power, either referent power or expert power, to then persuade people to do things that they otherwise don't want to do, which is what you're going to have to do as a manager. And here's the key takeaway from this whole thing. You need to listen to this. You need to listen to this. Excuse me, you need to listen to this. Because if you do all of this and you understand this, you then will become a model for other individuals. You will then become the model. And people will come to you and say, take me with you. I want to work with you. Will you be my mentor? Can I work with you? And here's the greatest thing about it, and the saddest thing about it. The greatest thing about it is you tell people, yes, I will take you with me. You can come with me. I will take you there. The saddest part is when you tell people, I'm not going to take you there. You're not going. Because of some kind of behavior, or some kind of lack of trust, or criminality, or some kind of neuroses, or pathological behavior, you're not going to take those people with you. So you're going to have to say no. That's the saddest part about the whole thing. But the greatest thing is you become models for other individuals, and you get to take them with you if they come to you and ask you to take them with you. That's the most amazing thing. So how do you do all of this stuff? You got to be super organized, totally organized. Okay, you got to totally plan out your life for at least the next 15 years. Okay, you got to know what you're doing. You can't be reactive in your planning, in your decision making. You can't be reactive because that's when you make your mistakes. You got to be strategic and tactical in your decision making so that you can leverage your decisions and know that the decisions that you're making are correct. And you can only do it if you have a plan. So the first thing is you need some type of strategic plan. You got to have 5 years out, what you're going to be doing in the next 5 years, and you got to update it every year going out 5 years. You have to rank from high to low what your major objectives are. What do you want to accomplish? The top 5 things over the next 5 years, and have it laid out. But life gets in the way sometimes, and you may have to delay some of the things that you've planned, or you may have to lower them from a higher order to a lower order. It doesn't matter if you do that. You can't get neurotic about it, because the only thing that matters is you achieve your goals. It doesn't matter if you achieve your goals in 3 months from now, or three years from now, or 30 years from now. It doesn't matter. The only thing that matters is you accomplished what you set out to accomplish. That's the only thing that matters. Then you need to hack up, go to the tactical planning stage, and lay out the next 3 years, and break out the 3 years into 6-month increments or quarterly increments, and lay out your goals and objectives, your metrics, in which you want to accomplish during this time period at a more micro level. Then what you need to do is you need to get a calendar and lay out the calendar. This is the best time of year right now in January during the break, where you basically map out your whole year. And you basically mark out the key milestone dates that you need to hit and nail over the next year. And then back into those dates and start hacking out periods of time that you need to sacrifice to achieve those goals. And then the most important is your weekly planner. Your weekly planner. You got to have your weekly planner booked for at least 2 weeks out. Try to go for 4 weeks out, but you got to have your 2 weeks totally booked out, which you're going to be doing every minute of the day for at least 2 weeks. You have to be marking the times that you have to sacrifice, and you have to keep open time periods to basically push opportunities into those areas. But it's got to be mapped out. And what's great is time is standardized, globally standardized. So you can totally plan out everything. And I hear all the time, I don't have enough time. No, you do have enough time. You just don't plan it. Okay? That's the difference. You have plenty of time. Because the world revolves around a standard work week. 5 to 8 a.m. in the morning, you can do whatever you want. 8 to 9 a.m., you got to get to your job. 9 to 12, you're going to work. You're going to have lunch between 12 and 1. You're going to work from 1 to 5. And then you're going to go to wherever it is that you need to go from 5 to 6. And then you're going to have 6 to 11 o'clock at night to do whatever it is that you need to do. So you have plenty of time. You just haven't organized your time. So it's not about a matter of not having enough time. It's a matter of planning it correctly. Okay, so the last two, and then we'll get out of here. Actually, we're right on time. I'll end it after this. So if you can do all of this, okay, which I highly recommend you do all of this, okay, because if you do all of this, here, can you be my camera person? Excuse me. Okay. I need some makeup for this close-up. All right. You're all going to be extremely successful individuals, no doubt about it. You're going to accumulate a lot of wealth over time. Okay. The question is, what are you going to do with the money? First thing I say to my students is, one, you're going to be extremely rich, and you're going to be extremely successful, so you better plan on it. But you better know what you're doing, okay? And I'm not convinced you do, okay? Because nobody teaches you financial planning or strategy in any of your courses, ever. So basically, you go into the real world, and you don't learn this stuff until it's too late. So I'm going to give it to you now, okay, so you don't make the mistakes. First thing you need to do, and I'm going to deviate a little bit right now, first thing you need to do is go home over the holiday season and talk to your parents and your family and be extremely honest with them and say that you're worried. Because if something happens to them, I don't know where the money is. And I don't know who's on the deed. I don't know whose name's on the bank account. I don't know who's on the stock brokerage accounts. I don't know who's on the will and the living trust. I don't know any of that information. If you don't know it, it's probably your sister, your brother, your cousin, your uncle, your aunt, your mom, your father. If they have it, you don't have it. Somebody else has it, so you're not going to get it. People will say that you're going to get it. You ain't going to get it until your name is on it and signed, okay? And everything's a promise. And when it comes to money, I've seen it. I've been a wealth advisor for over 10 years. I've seen it. I've seen families destroyed over money because they don't care. We're talking millions of dollars. What do you care? I don't care if I ever see my sister again. I get 10 million bucks. Can I live with that? Some people can. It's brutal. It's the truth. It's the world. This is the way it is. So the question is, what are you going to do with the money? First thing is, you guys got to find the money. That's your homework. Go have discussions. Go have the hard discussions now because you're emancipated. You're adults now. You're not kids anymore. Okay? You're adults. You need to know this information. So you're going to start accumulating wealth. Okay? In the United States, you're going to put money into a retirement account. If you work for a company, they're going to provide you with a 401k. Okay? They usually don't give you advice on how to invest in these 401k plans, so you're going to have to do that yourself. Okay? Which usually is not very good. Okay? Because you're relying on you. You're all finance majors, or you took my class, so you should have at least better knowledge to be able to make investment decisions. But again, it's really hard. Some corporations will match you. Take the matching money. Put as much money into these qualified accounts as you can. Try to save $1,000 a month for the rest of your life, okay? And if you can get an 8% rate of return in the market or in your investments, you're going to end up with $3 to $4 million by the time you're my age at 57 years old. $1,000 a month for 30, 40 years at 8%, you're going to be sitting on $3-4 million, guaranteed, okay? So that's the first thing you're going to do. Then when you leave your companies, do not leave the 401ks at the company. You want to roll it over into a self-directed IRA. I know for some of you, you're probably going to be going back to China, which don't have a lot of these things. Maybe they do have some of these things. But you need to listen to it too, because I have clients in the room that are going to stay here, they're going to go to Europe, and these investment programs are totally applicable. And you should probably know about them. Also, because you may come back and actually be working in the United States at some point in time. So you should know this stuff. So you're going to roll over the 401ks into the IRAs, Okay, if you're self-employed, you can put up to $50,000 a year into a SEP IRA program. And if you're really good and you're making a lot of money, you can put up to $250,000 a year in a defined benefit program, pre-tax. It's pretty awesome. You can get there pretty quickly. At some point in time, you're going to have about 25% of your wealth in these qualified pre-tax retirement accounts. At some point in time, you're going to max out over here, and you're going to be making too much money, and you're going to be forced into the after-tax realm. Since you're young, you'll be investing most of your money in equities, in stocks. You max out over here, you get thrown into the after-tax realm. You pay your income taxes, you start investing in real estate, in businesses, in other types of investments that have some type of tax advantages to them, because you don't want to get double taxed. You're going to have at least 50% of your income or your wealth over here, and you're going to be putting money in real estate, businesses, a Roth IRA, where you've already paid the taxes up front. So in 30 years from now, when you pull the money out, you don't have to pay the taxes again. And you may be investing in some insurance products there too. Then at some point in time, the real estate and the businesses and the other assets you've invested in are going to increase significantly through some type of wealth effect. And you'll go beyond this 50% allocation. At that point, you start selling off the assets to bring the allocation back into the 50%, and then you take the money and you bring it below the line into the after-tax safe realm, which is where you're going to be investing in tax-free California municipal bonds, cash value life insurance, fixed and guaranteed annuities, and basically building an annuity wealth that's going to be able to pay for your standard of living for the rest of yours and your partner's life, or you and your kids' life for the rest of their life too. And then you're going to hand over your estate to them in a tax efficient way so that they can live their life at a very high standard of living also. You're not doing it for yourself. You're doing it for your family also. Okay. Has anybody heard of the fable, the tortoise and the hare?
Yes.
The tortoise and the hare? Yeah. Who won the race?
Tortoise.
Tortoise.
Okay, you're the tortoise. Okay. I've seen a lot of hares in my life. They lose a lot, and they lose their family's money too. I've seen a lot of them do that. So be a tortoise. Okay. If you stick to the program, you win. Okay. If you want to take risks, you could lose. So the question is, do you plod along, do what you need to do to win, or do you take risks where you could lose? I don't know about you. I like plotting along, and I like winning. I don't like to lose. So how do you do it? What's the menu? What's the strategy? What are the tools to get to that $4 to $8 million in 30, 40 years? Well, you have to have a risk management strategy, and you got to have an investment strategy. The risk management strategy is basically using the insurance products as investment vehicles also, but also to risk manage, because you're worth $4 to $8 million right now. If something happens to you, everybody gets nothing. Okay, so you need to put in the life insurance, the convertible term insurance, the term insurance that's convertible into permanent life insurance, permanent, that's guaranteed to pay out if something happens to you. And as you put money into the whole life insurance policy, it accumulates cash value tax-free. And if you need the money in the future, you can pull the money out tax-free. And if you die, the death benefit goes to your heirs tax-free. How many times did I say tax-free? 3 times. 3 times. Is that a good tool? Mm-hmm. Absolutely. Can you get it if you're sick? Mm-hmm. Nope. If you don't believe in it, can you do it? Nope. You got to believe in it. You got to be healthy. Period. Variable universal life. I'm young. My income is variable. I can't afford the fixed payment every year for the next 30 years. I'm going to get variable universal life. So I can vary the premium payment that goes into the policy and as the stock market or the bond market, but mainly the stock market, as it appreciates, the investments within the fund are going to go up. My death benefit goes up and my cash value goes up. So this is a good product for people in their 35 to 45 range with some variable income. You can also get, when you turn 50, you want to get long-term care insurance if you can get it. You got to be healthy to get it. Why would I get long-term care insurance? Well, do you want your kids to pay $200 to $400 a day when you go into a congregate care facility and basically take out all of the wealth that you've accumulated and your kids' wealth just to take care of you in the last 10 or 20 years of your age? No. So you get the long-term care insurance. And if you have a business, a C corporation, you can deduct the long-term care premiums for you and your wife or you and your husband through your C corporation, through the corporation, pay for the premiums pre-tax. Pretty awesome if you understand how the world works. Disability insurance. If you're running a business and you get hurt, you're going to need some money, $5,000 at least a month, to be able to compensate for the income that you're now losing because you can't work. And companies, if you go work for a company and you work your way up, they're going to slap disability insurance on you and they're going to slap life insurance on you too. Because if you go down, you could take down the company with you because basically you were the company that was generating the majority of the intellectual property and the majority of the revenue of the company. So they're going to slap disability and they're going to slap life insurance on you too. Property casualty insurance. Do you plan on owning real estate?
Yes.
You better have enough property casualty, fire, and earthquake insurance unless you want to self-insure the property. Because if an earthquake comes and a fire happens and your building basically goes up in flames or gets red tagged because of an earthquake, there's nobody going to be in your building. There's no tenants that are going to be paying you rent. You're not going to be able to make the mortgage payment, and basically the bank is going to foreclose on you and is going to take the land and take the property, so you end up with nothing. So you're going to need the property casualty and the earthquake insurance. If you plan on going and doing your own business in the future, you're going to need business umbrella insurance, because when you run a business, people will target you and sue you and try to take money from you and extort you for the money. So you're going to need some badass attorneys from New York and Chicago to fly out here to basically take out the person that's trying to take you out, and you sick them on them, and you basically take out the individual that's trying to take you out. So you're going to need all that stuff. That's your risk management strategy, and there's also investment strategies in there too. Then what you're going to do is you're going to have your 401k. You're going to roll it over into a self-directed IRA, and you're going to invest in mutual funds, ETFs, stocks, bonds, and maybe even real estate you can put in there too if you want to do that strategy. The problem with this strategy is you're totally naked to the markets. You're totally susceptible to market swings. So if the stock market goes down or the real estate market goes down or the markets go down, your retirement account's going to go down. So that's kind of a bummer. So imagine if you were retiring 2008, 9, and 10, and you watched basically 25 to 45% of your retirement account evaporate within 2 to 3 years. You ain't retiring, okay, if that happens. So what's the solution? You roll over a portion of the money into a variable annuity with a guaranteed investment protection rider, basically a long put option, right? You buy a put option, price goes down, you get the money. So basically these variable annuities funded, backed by these large insurance companies, guarantee that if you lose, you put $100,000 in and the market crashes and your portfolio is worth $50,000, the insurance company will give you $50,000 and you will still have $100,000. So you lose nothing, okay? But you're going to have to pay them an asset management fee of 1% to buy that put option that will basically lock in your principal for at least 7 years. And as the value of the portfolio inside the annuity goes up over time, you basically lift the exercise price 3 times over a 24-year period, and you lock in your wealth until the put option expires. So very strategic. Okay. You can also roll money into a guaranteed future income annuity, guaranteed. I give the life insurance company $1 million when I'm 50. They promise to give me $100,000 for the rest of my life at 70. If I live till 80, I got my $1 million back. If I live to 90, I pulled out an extra $1 million. If I live to 100, which you'll all probably do in this room, because of science, you'll all be living until you're about 110, 120. So you buy one of these products, the insurance company basically is going to pay you, and you're going to get more out of it, and you're going to be able to live off the $100,000 per year, and you'll never spend through your money, your retirement account, and a lot of the money will be left for your heirs. So it's a really good product. And then fixed annuities, when you turn 90, you're not going to have any exposure to the stock market. You're going to have everything in a fixed annuity that will pay you enough to live until you die. Once you're done with this, okay, you're going to max out over here. Because the problem is if you overfund this qualified side, what's going to happen is when you turn 70 and a half, the IRS is going to show up on your doorstep and say, we want our money. And they're going to apply a formula, and they're going to start forcing you to pull the money out of the retirement accounts. And if you have too much money in the accounts, it's going to push you into the upper tax brackets and push you into the alternative minimum tax. So you'll be pushed into the higher tax brackets. So you got to be really super smart about it. The non-qualified side, you're going to put money in a stock brokerage account. So your money could basically be working for you. When you sell the stocks to buy the house, to fund your kids, to buy the car, whatever it is, you're going to sell it at whatever price it is, whatever the cost basis is, whatever the difference is, you're going to pay capital gains on it, either short-term or long-term capital gains. People also in this after-tax realm put a ton of money into these variable annuities with guaranteed investment protection riders. Why would they do that? Because it's totally unlimited. They can put as much money as they want into these annuities, and the money accumulates tax deferred in these accounts, and you only pay money when you pull them out. And if you do pass away, these variable annuity contracts will basically distribute the wealth to the heirs at a stepped-up basis. And they also asset protect, so if you ever get sued, nobody can take this from you. They can't pierce the veil. And then also, people like to put money into these guaranteed future income annuities after tax, because the IRS basically says that the $100,000 that you're getting, $30,000 of it is taxable. The other $66,000 is tax-free, because what you're getting is a portion of the $1 million that you put in. You're getting basically a recapturing of the basis. So they're going to basically giving you part of the basis back. So people like to put money in there, but not too much money in there. And then they put money in fixed annuities, real estate, and businesses. I'll go over there, I'll answer your question, and then I'll go over there. And then I'll be done. And we'll be done. Right on. And then I'll take your delivery. What was your question? Who's the accountant? I think it might be like 25% compared to 25 and 18. So the short term is higher than the long term. So if you hold the asset for more than a year, you're at the long term capital gains rate. If you sell it, under a year, yeah, it's 1 year. Yeah. So it's long term. That's why you want to wait and hold it. But if you're a day trader in stocks in a brokerage account, after tax, you're going to be incurring taxes. So you're going to have to make more money on your trades. The trading should be done in your qualified accounts. If you're going to trade securities, you trade them over here, because as you trade them, you don't pay any capital gains until you liquidate in the future. And you can start pulling money out at 59 and a half, but you're forced to take money out at 70 and a half. Okay? So over here, okay, ladies, you're not supposed to have your computers on. Okay? We're almost done. And I'm not a teacher, I'm a professor. Okay? So over here, you're going to accumulate wealth. Okay, your parents have accumulated wealth. Your grandparents have accumulated wealth. Okay, the question is, do they have the tax and the trust structures in place to be able to not only mitigate the tax liabilities, but also transfer the wealth efficiently? I know you think it's a joke, but it's not. This is real life. Okay, you'll be confronted with this. So here's how it basically looks. This is basically the diagram. Okay, so you're gonna have assets, or your grandparents and your parents are gonna have assets. Okay, and there's gonna be two types of assets. There's gonna be assets outside of the trust, and there's gonna be assets inside the trust. And at some point in time, they're gonna put assets that they can in the trust, in an irrevocable trust. Why would they put it in an irrevocable trust? Because when you pass away, the assets are going to go to the heirs at a stepped-up basis, and they'll be able to liquidate the assets and pay no tax. That's why you do it. But there's going to be assets, partnerships in real estate, partnerships in businesses, fractional interests in real estate and businesses that you can't put into the irrevocable trust. So they sit outside the irrevocable trust, basically naked. Now, you can set up a living trust that will basically tell, the trust basically tells who's going to get what, okay, when you die. And it will circumvent probate. And probate is where if you don't have a trust and you don't have a will, that the government's going to tell your heirs who gets the money and when they get the money. And a lot of your estate's going to be whittled away with attorney fees. So you got to plan this thing out first, and then figure out at what point you're going to start moving the assets into the irrevocable trust to go to the heirs. Then you're going to have the assets outside the trust, and then you're going to have a living trust that's basically going to tell where these assets are going to go. Now here's the problem. Most of these ownership interests in businesses and real estate are fractional interests. They're private interests. They don't trade in the marketplace. So they're highly illiquid. So that when you inherit them, you're going to get a tax bill. And you're going to look at the tax bill and go, I don't have the money for the tax bill. So what I'm going to have to do is I'm going to have to liquidate these assets to pay the tax bill. And if you don't have enough money that comes from the selling of these assets to pay the tax bill, you're going to have to pay the taxes, what's left over. So basically through bad planning by your grandparents' parents, they didn't leave you any assets. They actually left you a tax liability. Okay? That's why you need to go talk to them, okay, and figure out what's going on, so you're not being saddled with a tax liability. So what's the solution? The solution is what is called the irrevocable life insurance trust. Oh, I said the dirty word again, life insurance. It's called an irrevocable life insurance trust. It's a trust that basically the trust itself is the beneficiary of the rules of the life insurance policy. And what you do is you basically take money from here to fund the premiums, to pay the premiums on the life insurance, so that when you die, the trust receives the death benefit. Then the death benefit will extinguish the tax liabilities and the debt, personal debt, business debt, the real estate debt, so that all of the assets go to you, the heirs, at a stepped-up basis, zero tax, zero debt. So which one do you want? The first scenario or the last scenario? I'll take the last one.
Yeah.
I'll take the last one. Okay. So, I don't know about you, but I love taxes. I love taxes. I hope you love taxes as much as I love taxes. Because I don't know about you, I love income taxes. I love being saddled with 39 to 70% of my income being taxed by the government. Oh, and I love state taxes too. The state of California is awesome. You know, they'll take at least 10% from you. Capital gains tax, 20%, 25%, awesome, I love it, give me more. Recapture tax, you know, I depreciated my real estate over the last 30 years. When I decide to sell it, I not only get to pay the capital gains tax, but I get to pay the recapture tax on the depreciation I took over the 30 years. Love it. I love it. Retail sales tax, I love it. I love going out and buying stuff and paying retail sales taxes. And there's other taxes. I just love taxes. So that by the time you get done with accumulating all of that wealth, a lot of it has basically been taken by taxes. And if somebody doesn't take your money, the government's going to take your money through taxes, because you had really poor planning. So the last is estate planning. And you can actually start on this today. So the estate planning piece is extremely critical, and you all should start the planning process now. The first is to find out if any of your grandparents, parents, uncles, whoever, if they have all of this stuff structured. Okay? And if you're in the line of inheriting this stuff, you're not gonna get it if your name's not on it. So you better get your name on it now, okay, as soon as possible. And battle it out with your sisters and your brothers. And divvy up and figure out what the allocation's gonna be and get it written up in a contract, okay? Either the living trust or irrevocable, or get it, have your parents put together a will. And all of you should have a will. I know you don't have a lot, but you should have a will with a medical directive in it, okay? That basically states that if you get sick, or you get maimed, or you get hurt, and you're in a hospital bed, basically hooked up to a machine, that basically your heirs, or your wife, or your husband, or your siblings can pull the plug on you. Because basically what's happening is you're draining not only your wealth, but your family's wealth through your medical expenses. And you gotta do something about it. And it's gotta be in a medical directive in the will. Okay? So think about your family. Okay? The living trust, we already talked about that. Circumvents probate, but you don't get the stepped up basis. These are two of my favorite right here. The dynasty trust and the generation skipping trust. These are two of my favorites. Okay, let's do the scenario here. Ring. It's a Saturday morning, about 8 o'clock. You had fun the night before. So you and your wife are sitting around with your kids and you're having coffee and croissants and stuff like that. And the phone rings. Ring. Oh, Mom, how are you? Yes, I love you too. How are you? Yes. What? You did what? Honey, Mom set up a dynasty trust and a generation skipping trust. She said that since we're so successful, we're not getting any of the money. That our kids are going to get all the money. Isn't that great? Isn't that just super? So you get nothing. Your grandkids are going to get everything. Okay? So they skip a generation. But you don't care, right? You love your kids. They should get the money. You're already successful. You don't need the money. And there's a lot of tax advantages in this too.
And if you don't have kids?
If you don't have kids and your parents, well, get the irrevocable and the living trust and make sure that you get all the money.
Oh.
Your mom just wanted to, since you were so successful, she was going to give the wealth to them, to their grandkids, because they're so cute. And you don't need them. Okay. Charitable remainder trusts. You got a sitting on an appreciated asset, such as real estate. You throw it into a charitable remainder trust, you pull out the basis from the trust in a tax efficient way, and then when you pass away, the asset goes to the charity, and they sell off the asset and keep the money. And when you do these things and you put your charity on there, you could probably buy a seat on the board of directors too, because you just left them a bunch of money. But the thing is, you pull the money out tax efficiently by using this trust structure. And then there are intentionally defective trusts and other types of international trusts that a lot of foreign nationals use when they come over here and invest over here. And to be able to use trust structures, to be able to asset protect their assets, but also efficiently distribute their assets if something was to happen to them at some point in time. So the whole trust schemes are extremely sophisticated, but extremely efficient in not only asset protecting, but also transferring wealth. A lot of these schemes here were basically designed by rich people who lobbied Congress, and Congress basically put these advantages into the tax code because they lobbied Congress to implement these things in there. A lot of people that I deal with are not super ultra high net worth individuals. They're basically people like you and me. You would never be exposed to anything like this unless you were ultra wealthy or you came from a rich family, or you were exposed to somebody like me who basically told it to you because nobody's going to tell it to you. You're either going to have to learn it yourself, or nobody's going to tell it to you because you just don't have enough wealth for anybody to manage to be able to provide this type of accounting, legal, and financial advisory advice. So I hope this was valuable to you. I hope it helps. If you need any help academically, professionally, if you need letters of recommendation, you need statements, you want to use me as a reference for somebody who wants to call, talk to you, talk to me, to give you a reference, I'll do it, okay, but you gotta give me a resume, and you gotta coach me, you gotta tell me it's happening, you gotta make me a part of the process, because I'm not gonna do it if somebody calls me a cold out of the blue, and I'm not gonna give, you know, letters of recommendation to people if I haven't really been working with you and you've been working with me. Okay? So we're right on time. So thank you very much. Turn that off, and then I will take your